Hello, I'm Rick Cromer. I've been a trader for many years, and one of the best tools that I found for trading options is in thinkorswim. And one of the features of thinkorswim that I love so much is called the risk analyzer. And so what I want to do is I want to describe that and what some of the features are, and to help new people learn it, because it's just something that will really help your trading. In today's presentation, I will talk about that risk profile. The risk profile will help you identify what your potential profits are at different times through the trade. You can vary it for all sorts of conditions, whether it be future dates or changes in volatility, or you can use it to try to help you trade by helping you do price discovery by looking at where the price would be at a certain point in time, or a certain price that the underlying has moved to. And then we'll look at just a real basic trade, and I'll show you a couple different ways to enter that trade, and then we'll look at that trade to see what the P&L looks like using the risk profile. There are some assumptions that I want to make on this presentation, and these assumptions are that you're familiar with trading options, because some of the terms I tell you that I'm selling a put or buying a call, they won't make any sense to you if you're not familiar with trading options. The next thing I want to talk about is buying power and risk, because there's a distinction between those two. If you're an options trader, you should be familiar with statistics and what probabilities of the trades would be. For example, the probability of being out of the money at expiration, the probability of a touch, 1 standard deviation, 2 standard deviations, 3 standard deviations. That should be something that you should know if you're an option trader. There's other resources that you can go back and look up to try to get more information on that. And then I'm hoping that you want to learn more about the thinkorswim platform, because like I said, I really love it, and I think that you will too. So this is a very busy slide. I captured a picture of the risk profile, thinkorswim. I've highlighted all sorts of different points on this page so that we can talk about it. So let's start off. Easily the first thing that you want to know is where you put the symbol. This is where you type in your symbol. There are quite a few drop-down options on this. So you can either look at what you've typed in recently. You can select just futures. The nice thing about selecting futures, you can see the margin required for that option contract. You can not only put the symbol of a stock that you want to look at, you can put the symbol of an option. The next thing that we're going to talk about is expiration date of an option. That goes into this field on the right here. That expiration date may be set to the current date. Depends on how you entered this screen, but you'll want to set it to the day after expiration. So for example, this option down here expires on September 19th. It's set to September 20th. There's another date field on this screen, and that is the date that you're currently evaluating. This is the date that I captured this screen, and if I want to evaluate this particular trade and how it's progressing, what my P&L is at that point, I can change this to a future date. I want to talk about what you're actually seeing on this chart behind all these call outs. On the very left-hand column, you have a P&L. You have the price axis down the bottom. That's the price of the underlying. So this is saying that right now SPY is currently priced at $642. You can also see that in the price slice. So that's the at the money price right here. It's showing that we have $0 offset from the current price. It's showing you the current Greeks at the money. For example, the 16.5 delta, the minus 0.762 gamma, and 11.644 theta, and shows Vega, and shows the P&L for the day, the P&L from the open. The next thing I want to talk about is what's on this chart that you're seeing. So we know that this is the price of the underlying and this is the profit. This blue line right here represents what that option is going to be worth at expiration. So you can see this is a short put. Sold a put at 614 for $2.92. In option terms, this option represents 100 shares of stock. So that 292 is, or the 2.92 is actually $292. So this horizontal blue line right here is at the $292 point. Also, right at the 614, where that short put is the current strike, you can see that it starts heading down. About a $1,200 loss if the stock price goes down to about $600. So the break even is represented by this little red dash here. It's going to be at 614 minus the 2.92. So we got 611.08, and that would be right where that red line crosses. Another point of interest on this graph, this is showing you the current date, the 1825, showing you the date of expiration, the cyan color, 9/20/25. So let's talk about the current price on here. When you first open a trade, that magenta line should be crossed right at the 0 P&L line. You can't make money until you enter a trade. But once you're in the trade, as the underlying price goes up or down, you're either going to make money or lose money. If the volatility changes during that time, then depends on whether your vega is positive or negative, will mean that this magenta line is going to move up or down. In this case, we're at a negative vega, so if the volatility increased, this magenta line is going to go down. And you can see as it goes up, it gets close to its full profit even before expiration. The next thing I'd like to show is the price slices. This is kind of obscured now by this call out, but this is the price slices section. The price slice section has a context menu on the right side, and sometimes these are referred to hamburgers because of the 3 layers. But this context menu is a menu that is related to what you can do in the price slices. So in this case, if you want to change the price slices to plus or minus 5%, you can click on that menu and you can set the price slices to plus or minus 5%. My default that I usually like to see on an option trade is the plus or minus 1 sigma, which represents standard deviation move of a plus and minus 1 standard deviation. When you get a plus 1 standard deviation in the price slice, it's going to give you that price of where that plus 1 standard deviation occurs, and that's at $674 on the underlying. If we go to this graph right here at $674, we can see this dashed yellow line, and that dashed yellow line represents this first price slice. The second price slice, which is actually the current price of the stock, is this middle dashed line, and then the minus 1 standard deviation is at 614. You can see it by this vertical dashed line. If I were to click into this area, what it's going to do, it's going to move my price slice, and it won't be showing me my minus 1 standard deviation. So what I can do to fix that is easily go back over here and just click this lock, and it will go back and set it to the minus 1 standard deviation. Or I can go back to the context menu and I can say set my slices to plus or minus 1 standard deviation. The next thing I'd like to talk about is the range within 1 standard deviation. This drop down right here, you can set it to 1 standard deviation, 2, or 3. And what it will do is it will change the range of this gray shaded area. And this is the The 68.27% represents one standard deviation move. And I've highlighted that with this little yellow thing. I'm trying to indicate that this shaded gray area is that one standard deviation by putting this yellow brace on top of this. That's not normally there. But what you can see inside this, if you look carefully, is you'll see a percentage. And what those percentages are the probability of this price being in that range at expiration. So there's a 32.46% that the stock price is going to be below where it currently is and above the one standard deviation move. There's a 15.86% chance that it's going to be outside of the one standard deviation move. Now, of course, if I change that to two standard deviations, this whole thing gets wider and the gray will change, but these price slices are still set on one standard deviation or two. And so what you'll have to do if you want to see what that price slice looks like is select this drop down right here, select -2 sigma to get a two standard deviation drop. Then that price slice will represent that two standard deviation change that you made up here, so you can see what the price will be at a two standard deviation drop. You can see where that lies on the graph, and you can also see the probabilities of that happening. There are two different types of trades that will show up down in this bottom section. The positions that you currently have and the simulated trades if you've created a simulated trade. In this case, I created a simulated trade to sell one option of SPY expiring at September 19th at the 614 strike. I'm selling that. That's going to be a put. And right now it looks like the bid will be 292. And what we'll do when we enter the trade is we're going to look for probably a midpoint instead of the bid, so we can get a little more credit for our trade than that. And we're looking at this right here. It's showing a delta value of 16.5. 16.5 also represents that point right here. And it also represents in this case, a one standard deviation move down. There'll be a 15.86% chance that this option will expire down here, and it'll be about a little less than 85% chance that it will expire above this short strike at 614 to be fully profitable. So that's a pretty high odds on being profitable. The trade-off for those high percentages are that you get paid a fixed amount that's limited, where you can have a variable amount of loss. So you're getting paid at a high percentage, a fixed amount of money, because you're taking the risk of a big down move. The positions and simulated trades also has a context menu that's located on the same line as this header for this section. And this context menu represents actions that can be performed down here. Some of the common actions that I like to do is doing a reset, which resets your date and time, resets volatility if you're going to change volatility. If I do want to see the effects of a volatility change, I can select this gear right here, and we'll get a new little box right here, an entry field, that we can adjust the volatility up or down. And I'll show you that on a subsequent slide. And the last thing I'd like to show you on this slide is the amount of buying power a trade will take. This is saying that it will take $61,000 to sell this naked put in a cash covered account. If you have a margin account or portfolio margin account, that number will be less. Okay, so this is the same graph that we're just looking at, and you can see that we can get to that from the analyze and selecting risk profile. But we can select this option right here called lines, and I'm doing 4 lines, and I'm day stepping those lines, and I'm stepping it by 8 days per line. So you can see that down here on the little table that's created, and it will show you the different dates separated by 8 days each, and it will show you the P&L for each of those dates based on, right now the cursor is at 6.25. I don't click on this, but what I do is I just move my cursor over this chart, and it'll show you a number right here, that 419.91 of loss. Remember, the pink line is the current line. Sometimes they call that the T0 line, but you can also see that same line right here. Today's 8/18. You can see that it's a $419 loss if the stock price falls down to $625. Well, we hope it doesn't happen, especially the same day we enter a trade, but I'm doing this for illustration purposes. And you can see if we go up to the next line up here, it's that cyan line, and the cyan line is only losing 300. So if we made it 8 days into this trade and it went down here, then we'd only be losing 300. If we went 16 days in this trade, about half a month, we'd only be losing $142. But if we were 3 weeks into this trade, we would be at a profit of $49, and if we were getting close to expiration, our profit would already be $274, maybe even close enough to go ahead and close this trade, because there's no sense trying to get a couple more cents when this could be a disaster and falling off the edge. So use this to kind of evaluate what your trade is going to look like over time. Remember, this field right here is your current P&L, and the fields above and below that are the P&L at a plus or minus 1 standard deviation. This next graph shows what happens when you adjust volatility. Typically, when a market sells off, VIX goes up, the volatilities are higher, so that options, using the different option models to calculate the price, take into account of volatility. So if volatility goes up for a short option with a negative vega volatility, with a negative vega, what you'll see is you'll see a move down of your profit lines, your profit curves. I'm still using that 4-day 8-step, and even at the current price that we open this trade at, you can see that the current T0 line, or the current P&L line, is at a loss of, and I'm just going to estimate, maybe about $600 at this point. So you can see the impact of a 10% increase in volatility. We did that by selecting this menu option right here, and then the stock price and the volatility adjustment fields open up, and then you can adjust the volatility and see what impact that has for that. Now, if you want to see what it looks like in the future, let's say another couple days in the future, you can use this field right here, and as you advance the date, it will comprehend the decay and show you what these price slices will look like in a future time frame. And well, we may not need to be using these day steps. By stepping up this date, you can see the effects of these day steps on how they move over time. You may not be using these day steps. You may be using, I want to see one expiration. And then you're only going to see the magenta and the cyan lines as the T0 line, or the today line, and the price at expiration. You also notice too, we're still at 1 standard deviation on the probability range, but this gray area that's in the background that represents that probability range now extends beyond the range of this whole chart. And the reason why is because if we get an increase in volatility, the 1 standard deviation range also increases. So that 1 standard deviation range is dependent on the volatility. And on the other hand, if volatility decreases, this whole range will shrink down. Okay, so let's talk about the price slicing menu a little more. and I want to show you some of the options on it. So what I've done is I've selected that hammer under price slice, which is this menu right here, and I've just got a portion of that screen. If I go back and I show you the whole screen, this is the menu item that I've selected. And when I select that menu, this is what comes up. I can set slices, and it has a lot of different options. I can set those price slices by a percentage. I can do a uniform stress test is used as part of the margin calculations for a margin account. I can set steps where the price slices are every 5%, so I can get a 5, 10, 15, 20. I can do plus or minus 1 standard deviation, and I can do the same thing for 2 and 3. One of the features that I seem to use quite a bit is this break even, and I like to do it at break even at expiration, which is expiration of this is 9/20/25. And what that does is when you set this to break even at expiration, it's going to go back on the trade, and wherever this blue line, cyan line, crosses this 0 line, that's a break even point at expiration. Now, if I want to do a break even at 8/18, it would be right here where this magenta line crosses the 0 line. The top slice I set to a -1 sigma base plus 1 sigma, representing plus or minus 1 standard deviation. And since this is also set to 1 standard deviation up here, these vertical lines will appear on the edges of the grade area. So again, the price slices control these dashed yellow lines, and this drop down right here represents the gray lines. So it's common when you use a new symbol or a new option that your analyzer chart just doesn't look very comprehensible. So we need to do a little cleanup on it. Usually the first thing that we want to do is we want to set the expiration date to the date that that option expires. When I do that, I set it to 9/20. This is the result. You can see that the 1 standard deviation area becomes relevant to that particular option's 1 standard deviation area, and is not near as big as it was on that original screen, because this was showing today's expiration, so it didn't really show the options 1 standard deviation range. The next thing that we want to do is we want to move this towards the center of the graph, and to do that I actually move it all the way over to the left because I want to expand this 1 standard deviation area so I can really see into it to see what it looks like during the trade. So I click anywhere in this area right here and hold the mouse down and just drag it to the left. Typically what I'll do is I'll get that left side of that grayed area real close to the profit axis over here, the y-axis. For example, like this right here. So this is the case where I dragged it over to the left. It's kind of hard to look at it like this too, so what I want to do is I want to expand it. And to expand it, what I want to do is I want to drag this price scale. Let's drag this price scale right here to the right. By dragging this price scale to the right, we're basically zooming in on this area right here, and this is what it looks like after it's being zoomed in. So the next thing I want to do is I want to get my price slices set right. So this vertical line right here doesn't mean anything, and you can see down here it's not set to a plus or minus percentage or plus or minus standard deviation. So let's go ahead and do that. And what I'm going to do with that is I'll go ahead and select this menu right here, the context menu for the price slices, and I'll select -1 sigma, +1 sigma, and the result of that I get the price slices on the chart right now at the end of this 1 standard deviation range, and these price slices right here reflect the +1 and the -1 standard deviation range. So they're all in line. So Now if I want to look at the Greeks at one of these 1 standard deviation ranges, that's available. I can also see what my P&L would be at that price range. And so you can see like the P&L for the day would be this right here, this point right here, and showing down almost $1,000 if it went down there today. And if it went up to this 1 standard deviation range, it would be up $300 on it. And you can also see what it is at open, which is really that cyan line or the T0 line, right where it crosses this yellow hatched dashed line, and where it crosses this right here, which would be, and of course, since open is the magenta line, so it would also reflect that same thing as that 1 day, because here we are at 0, and we went down, we would lose at $979 in value of that trade. The next thing that we're going to do is we're going to talk about how to put a trade in. In this case, what I want to do is I want to put in a back ratio spread. And we want to buy that because we're looking at possibly creating something that we can make money if the market just totally tanks. And we want to keep the cost down. If instead of just buying puts, we're going to do this back ratio spread. So I'm going to show you 2 different methods for doing this. The first method is to right click on the option chain, and what I'll select is to analyze buy trade, because I want to buy a back ratio trade. I'll select analyze buy trade, and I'm going to, because I want to analyze this, I want to do a back ratio trade. And so by me right clicking in that 600 strike put option chain, it creates this trade down here. It gives me a short 600 put and 2 long 595 puts expiring in October. So it's going to cost $323 for this trade, and that $323 is that cyan or blue horizontal line right here, represents that $323 loss at expiration. You can see that it's potential that this trade could lose more if it expired in this little valley right here. Typically what you'll see is this T0 line, the magenta line, gradually moves down towards the bottom of this curve. Once you see that magenta line getting close to the bottom of this curve, you go ahead and close your trade so that you don't risk that extra loss. Typically, if the prices move down, you're going to have an increase in volatility, which will raise that current price line up higher, the T0 line up higher, because of the increased volatility. That's rarely ever going to be a problem, and if you're watching your trade at all, it's easy to prevent that from happening. Our next technique for creating a trade or adding a trade into the simulator is clicking it in. And I tend to like to do this because I can do this pretty fast, and I know what the trade's supposed to look like. I know that I want to sell the 600 and buy 2 595s. So I click over here under the bid. I'll click that once, and that will give me this simulated trade down here that I want to sell that 600 put. And then what I'll do is I'll hit the control key and hold it down and click twice in the ask. That will create a buy order to buy 2 of the 595 puts. So here's that trade that we added in as a simulated trade. Type of spread is a back ratio. We're selling 1 600, buying 2 595s, and it's going to be for a $323 cost on it. And again, this line right here, it's kind of a yellow line, represents that max loss except for the valley. And I'm doing day steps, so we can kind of see every 15 days how this is progressing. I put my cursor on this in this chart at the 617, almost $617 price, just to see what the P&L is going to be for each of these periods. And we could see from the table over on the left Our current P&L is going to be 484. As decay occurs, it gets less. So the cyans decayed a little more. I don't know what color this is, but this middle line right here has decayed more. Maybe it's an orange. And then this kind of gray line has decayed even further and now at a loss. So over time, just sitting here, this is going to decay into a loss until it gets down towards this yellow line, which is close to the expiration date. You notice that we expire on 10/18. This is 10/17, so we probably have a day to 2 days left on this trade before it expires. So if the price of the underlying, in this case SPY, goes down to $617, we're going to have a profit of $484 if we close it. Next that I want to look at is if the volatility increases, I want to determine what impact that's going to have on my P&L. So if I select this option right here, this little menu button, and I click it, and it adds this volatility field, I add a plus 10%, and you could add whatever percentage you want. And I typically look at a 10% change. That doesn't seem to be too much of a volatility change, and does happen on a sell-off. So if it were to sell off the same day that we open the trade, later in that day, it sold off to 617 or 616.98. We would actually be up $1,342 already when the market has gone down. If we wait, if this happened, looks like 15 days later, we're doing day steps on this price curve. 15 days later, we would be up 1,033. 30 days later, get $650 profit. Even 45 days later, we're still profitable at $177. Again, getting close to expiration, that gets close to zero. So that last week or two, you don't usually want to be in the trade because you can lose a lot between these 2 points. And if you look, if we were all the way down to 590, so or maybe even 600 right here, and just those 2 weeks, that's a pretty big drop in decay. So the floor kind of falls out from underneath you in the last couple of weeks, so be aware. So a little about me. I've been trading for 30 years and over 25 years with options. I actually started in mid to late 90s, but boy, I didn't know what I was doing at that time. I just kind of seen what happens if you bought and sold them. I own a company called Cromer Wealth Management. In this company, what we try to do is help investors to trade their portfolios safely. There's so many other services out there that will show you a trade and say, hey, we make 200% or 300% on this one trade. But what you're doing is you're trading a few pennies into in a large account, and now you're, instead of a few pennies, you got a lot of pennies. You can't trade a large account trading a single stock option. It just doesn't work on these trades because some of those trades have 100% losses. So what we're trying to do is we try to give you the positions that you can pick from multiple options. There's different risk tolerances, and you pick which tolerance that you are comfortable with, and you put those trades on at the beginning of the month, and then new updates come out at the beginning of the next month, and you adjust your positions. Sometimes there's no changes. Sometimes you're just readjusting size. But if you want more information about that, please contact me, and I'll tell you my email address. But my email address is rick.cromer@gmail.com. So rick.cromer@gmail.com. And if you're interested, you can join our free Discord server. That's where we actually publish the premium trades for subscribers into that server, and those will be hidden from you as a free guest. But if you want to become a member, that's where you'll get your trades. I also publish trades that I'm doing. If I'm doing an option trade that I think that looks good and has a high probability of making money on it, and minimum risk, I'll publish that trade there, and then I'll publish what I got in it for, what I got out of it for. I'm completely transparent on that, and those are free. And you can get those just by signing up for the Discord server. And if you're interested in signing up for our service, you can go to cromerwealth.com. Thank you for your time, and appreciate you sticking with me. Thank you. Bye-bye.